Welcome to Walk Away Wealthy. I'm your host, Alan Terrell Gregory. If you're thinking of selling your existing business or looking to untangle yourself from your old business so you can start a new one, you came to the right place. Today, I have a very special guest, Benjamin Bender. Welcome to the show, Benjamin.
Thanks a lot, Alan. I really appreciate you having me on.
Absolutely. So tell us a little bit about yourself.
Yeah, thanks. Like you said, my name is Benjamin Bender, and I'm a partner at Carson Wealth, which is a registered investment advisor based out of Omaha, Nebraska. So basically, a registered investment advisory group. We register directly with the SEC, and we function as fiduciaries for our clients. So our headquarters is in Omaha, Nebraska, but my branch and in my business is in the Denver area, specifically the south suburbs of Denver. And been here for about 20 years, a little bit over 20 years. And I've got a family, wife and kids in the area. And we've been calling this home for quite some time now.
Great. So how and why did you get started helping business owners with retirement?
That's a great question. So when you start off as a financial advisor, you're doing a lot of cold calls, a lot of marketing, all that stuff. So early on in my career, I was getting out and speaking with people, as many people as I could find, and you're trying to locate clients. A number of conversations I had were with business owners, whether that be from the Chamber of Commerce or friends of acquaintances or people that I just found while cold calling or marketing. And business owners have a lot of different needs, complicated, a lot of moving parts to their plan. So I found it to be very interesting work. And business owners, if you have a successful business, means if you have a business that's been around for a long time, means you're at least pretty successful and you've amassed a really significant asset with your business, and you're going to need to convert that to an income stream down the line at some point in time. And I just found that work to be very enjoyable and interesting. And business owners tend to be go-getters. Obviously, they're starting up a business from scratch. So I enjoy working with very driven people like that.
And what are some of the common challenges business owners face when thinking about retirement or potentially selling their businesses?
Yeah, I think that the challenge that business owners have when they're trying to exit their business is there's a lack of education, generally, and understanding of what is all available to them. So are they going to sell to a management group inside of their company? Most people who have small businesses, it's a family business. So are they going to transition their family business to the next generation, and the challenges that come with that, because the next generation is highly motivated, but they don't have a lot of capital to buy out the existing business owner. So you've got education on all the different options and how sales are structured and how they're taxed. And so I just don't think that business owners really have a complete knowledge of everything available to them. The challenge with us is we want to make sure that we're working with business owners and equipping them with the right information for them to make confident decisions. And so the education part is really important, and that's going to translate into better decision making on the part of our clients. And that's important to us as well, because when you're a registered investment advisor, you're a fiduciary, legally speaking, to your clients. And we're not living up to our fiduciary standard if we're not properly educating our clients on all their options.
So speaking of education, let's see if we can break this down a little bit. So what's the difference between an RIA, a financial planner, and a financial advisor?
So a lot of it is basically industry jargon. So if you're going to go to somebody at Carson Wealth, such as myself, or an advisor at Morgan Stanley or what have you, everyone's going to call themselves financial advisors. So what you're really looking for when you're working with somebody is, are they a fiduciary? And when you're a registered investment advisor and you're registering directly with the SEC, instead of through a broker dealer like a Morgan Stanley or something like that, that's a different level of care, and we're held to a higher standard. And when you have a CFP, which I have a certified financial planning designation, that can also be a fiduciary role in certain states. So it's really important to us, to me and my office and my staff, to make sure that we're getting those extra designations and making sure that we're serving in a fiduciary capacity. And if you're going through a broker dealer, they have a different standard. It's just a suitability. So, hey, is this investment or is this approach suitable? It doesn't matter if it's quite in their best interest. It's a different, not as high as stringent of a standard.
So I want to take it back to something you said earlier about family business. So what happens when an owner that has a family business wants to sell, not gift, sell their business to their children, and the children don't have the funds? How does that work out?
Well, there's a lot of different ways you can structure that, and it's really going to depend on the industry specifically. So, in my industry, if I was going to buy another financial advisor out, if they were retiring or what have you, there's only certain people that can be involved in that transaction. You have to be licensed. It's not like I could sell out my business to a private equity firm or something like that. The different industries that people are in have different standards, and this would make sense. Like if you're a physician and you can only sell to other physicians your practice. So when you're trying to transition that to a younger generation, the funding is important. So are they going to go get an SBA loan? Do SBA loans exist for this industry, and how are they structured, and what's to be used as collateral? And for the next generation, a lot of times there's going to be earnouts and promissory notes in addition to the upfront amount, because your ability to borrow from a institution like the Small Business Association, it's going to vary on a number of things, but it's going to vary most importantly on the assets that you've amassed. Most 30-year-olds, 35-year-olds, or what have you, haven't really amassed a ton of assets by that age, but they have all the motivation in the world to make it work. So you're really approaching that situation from a number of different avenues.
So as SEPAs, we both know what the three legs of the stools are. Can you kind of break that down for the audience a little bit?
Yeah. So the exit planning philosophy is a master planning philosophy. So we're gonna work with clients, handling everything from soup to nuts. The first thing that you want to look at is a personal plan, and so personally, how much longer do you want to work? What's your end goal in life? What if you're going to exit your business, what are you going to go do next? What's the next challenge for a business owner who's probably a very driven and active person? And there's that saying, a goal without a plan is just a wish. And so you want to make sure that we're not just putting wishes down and having no not building out a framework to achieve those goals. So that's the personal part of it. And a lot of business owners are so focused on building up their business that tends to be neglected a lot, because building a successful business is all encompassing. It's an immersive process, and some things naturally fall to the wayside. But if a business owner is going to have a successful exit of their business, it's got to be exiting towards another destination. So that's one part of it. And once you kind of know the goals and things that you would like to accomplish in life, most of those things have a dollar sign attached to them. So that's where the financial planning comes in. So for instance, if I wanted to, buy a yacht and sail around the world with the proceeds of my business, we're going to need to figure out, how big of a yacht do I need? How many people are going to be working on that? And it could be something else. It could be, well, I'm just going to buy a home in a different state or a different country and live on the beach or whatever. Whatever those goals are, there's a dollar sign that's attached to it. So as a planner, this is where my background being a financial advisor for 20 years comes into play, because we've been just designing these businesses, or excuse me, we've been designing these plans for people forever. Now we're just working with business owners and doing the same thing, but on a much more involved scale. So that's the financial planning aspect of it. And then finally, the business planning. If your financial plan says, okay, in order to get the life you want, you're going to need X amount of dollars. Okay, well, how much of that, how much of those dollars do I need to get out of my business? And that's when you start looking at informal valuations, formal valuations, what you can do as a business owner to make your business as attractive as possible to prospective buyers. So it starts at the personal level, then you assign dollar amounts to it, and then you got to take a look at the business and say, okay, what can I do with the business that will yield the amount out of it that I need to achieve this overall master plan?
So for the listeners, to recap, the three legs of the stool, as per Exit Planning Institute, aka EPI, is business, personal, and financial. So Benjamin, what I want to talk about now is the personal side, because the business and the financial is just numbers. It'll take care of itself. But the personal is going to be the foundation. So what is it that you find people usually do when they exit their businesses? Do you give them advice as to what to do, or do they have a plan? Like, how does that work?
Yeah, we talk them through it. So, Alan, I'll pick on you and me, because as men, a lot of our identity is wrapped up in our business, and a lot of my personal relationships I found through work. And so, for people in general, but a lot of men in particular, there's sort of a loss of identity when you stop working, because everything is so wrapped up in that. So it's important, and on and on a serious front, a lot of people can suffer health problems in their first year of retirement just because they don't have anything to do and they're not productive. And people need to feel productive, and they need to have that self-worth. So we talk to our clients. Are you gonna, if they're in Colorado, are you gonna stay in Colorado? Are you gonna stay in your current residence? Do you have a budget for whatever passion you have? One of my clients goes to a lot of bluegrass concerts around the state of Colorado. That's what he is going to want to do a lot more of when he's retired. So you find out what people are interested in and what they're passionate about, and usually that involves at least some outlay of money. And then you would go and say, okay, well, are there people who are the people that factor into this financial plan? Do you have people that are potentially financially dependent upon you? Do we need to support them? And you move through the general interview with clients. It could be charitable contributions or gifting to families. You want to go through. We have an entire profile that we put our clients through, so we can get to know them, because very little in life doesn't involve money. And besides family and faith, money tends to be the third most important thing to people. So we want to know as much about our clients as possible and really get to know them on a personal level. So we might be able to make really good suggestions involving their overall plan that may not have occurred to them.
So one of the things I do to advise clients is I tell them we need to get the business to a place where you can take a 2-week vacation and your business doesn't burn down. Right?
Yeah.
Once we do that, then we need to start taking 2-week vacations consistently. Maybe once a quarter, you take a 2-week vacation, and you get to kind of test the waters of retirement, because you may say you like fly fishing, you may say you like golf, but if you're doing that for 2 weeks consistently, you'll start thinking about other things that you might like to do. So it's kind of like a pre-retirement kind of test, so to speak.
I think, Alan, I think that's great. And there's multiple instances of industries doing that. For instance, if you're a high-powered attorney at a big-time law firm, after about, I think, 5 to 7 years, it's very typical to take a sabbatical. And if you've only been away from your business for a week at a time, a week and a half at a time, that's barely enough time to get settled into a routine that doesn't involve business activities. And so, I struggle with being bored if I don't have enough to do. And I know that I'm not the only one that is afflicted with that problem. But that kind of stuff is very sage advice. And it gets people to really look at life beyond work in a different way or through a different lens.
Yeah. And so we talked about the EPI's three legs of the stool. I've got my own kind of personal three legs of the stool, which I think you'll find very interesting here. So
Do tell. Yeah, let's hear it.
So it's exit planning first, then it's the liquidity event, then it's wealth management. You've got to take those three steps. Like it's 1, 2, and then 3. So can you speak to that?
Yeah, I mean, I think I'm biased here, but I think that wealth management is a process that that should be in place before the transaction liquidation. You're dead on as far as the sequence of events, but most business owners will have some sort of investment. It's usually their business is the largest investment, but a lot of them will have 401ks or IRAs or investment accounts, and many will have like a reserve fund for their business. So they should be doing some financial planning along the way. But when you get that big check for the balance of the company, I mean, there might be earnouts or promissory notes, but usually there's an upfront large payment. You got to consider taxes. You've got to consider how much of that you can pull out on a monthly or yearly basis to support your lifestyle. And usually when people get a money handed to them, whether that's from a sale of a business, a big quarter throughout a big fiscal quarter, perhaps an inheritance, usually there's a couple of things that the business owner is kind of, or the person is sort of really into buying. Like, I've always wanted this type of car, or I want a fancy watch, or I want to take this swanky vacation. So usually there's an event to be planned for right after that transaction of closing the business happens.
So I'm not asking you to give specific tax advice, but I do want you to talk to how important tax planning is in this whole process.
Yeah, I mean, tax planning is really important. So we don't do tax returns. So that would be more of the CPA. And I think you obviously knew that. But some of the things that I would be very mindful of, whether that's discussions with a financial advisor such as myself or with a trusted bookkeeper tax preparer, is there's going to be what portion of the transaction is going to be taxed at ordinary income versus capital gains. Because even if you're a really successful business owner and makes a bucket of money, the maximum capital gain tax rate right now is 20%. And sometimes it's been higher and a couple times it's been lower, but 20% is a far cry from being in the highest marginal tax bracket in the 30s. So that's a big decision to how are you going to receive those proceeds. Other things that tend to come up as well, if you get a big chunk of money in 1 year and you're retired, well, if you're on Medicare or something, that could have an adverse effect on Medicare premiums. Also, if you have, let's say, losses that you could take. I mean, obviously 2022 last year wasn't a very good year in the stock market, and we're gonna have those from time to time. But being proactive, are there harvested losses that you took on your portfolio that are being carried forward that could offset a capital gain on the sale of your business? One thing that really catches people when they're selling something that they've depreciated is depreciation recapture. Because, and again, yeah, I'm not going to start giving out tax advice, but I believe off the top of my head, I believe that's a 25% max tax, because you're deducting that depreciation. So when you recapture it off of a sale, then you're going to be at a higher tax bracket than a capital gain. So there's a few different things. Obviously, if you're itemizing taxes or taking a standard deduction, gifting to charities could definitely factor into that. So there's a number of things. And then getting into the really ugly part is taxes on estates, if you're over the federal estate tax limit, they're very, very high. And that takes a good amount of planning with a CPA and estate planning attorney. So that was probably a half a dozen that off the top of my head would be, front of mind when you're dealing with a transaction of that nature.
How much time is needed to plan and execute a successful exit for a business owner?
Yeah, I mean that's a great question, and it kind of just depends. There's a at the Exit Planning Institute, they I know you're well aware of this, but for the benefit of our audience here, there's the 5 Ds. So divorce, distress, disability, death, disagreement. There's these things that can happen in the course of running a business. You could have a disagreement with your partner, you could have a divorce. So there could be forces outside of your control that are propelling you to make a decision faster than you otherwise would. So to answer your question, it depends on what's going on. I usually find in working with people that it's 3 different time frames. The first one is like immediately. Hey, I suffered a medical issue and I need to get out of my business because I can't handle the stress anymore. That's usually about 0 to 18 months. And at that point in time, you're focusing on making sure that all the operating agreements are in place, all of the contracts with your important customers are secured, and so on and so forth, so that you can have a positive sale. Maybe not the best that you could have given the time constraints, but you can still piece together a better sale than you otherwise would have. And then it's, you get into about a 2 to 5 year, which would be the intermediate. We've got some time to work on stuff. And then there's people that I work with that have time horizons of 5, 10, 15 years. And when we work with those people, we have a set list of tasks and timeline to accomplish those, but it's more of let's get this business so we're sell ready on a moment's notice. So if I get the ideal buyer or someone who's ready to pull the trigger and the macroeconomic factors are right, I can get top dollar on my business because luck favors the prepared.
Do you find that owners are starting to take this exit planning specifically, more seriously than they were in the past, or is it just like another box to check for them?
For the client, do you think like the overall public is taking this type of planning more seriously?
Correct.
I think that the answer is yes. I don't think it's like super dramatic, but I think that in general, the baby boomer generation had parents that retired with a pension, and they really didn't need to take very much money from their investments. They didn't need to think about the dividend yield on their portfolio and how that would supplement their income, because if they have a pension and they have Social Security and their house is paid for, that's 90% of the way. But the baby boom generation, they're the ones that have gotten those defined benefits like pensions kind of started being taken away from them. And then unfortunately for you and me, we don't really have any of that stuff. So if you're a business owner, it's going to be more important because you have an illiquid asset that you're converting to cash. There's a liquidity event there. But then if you're 60, so if you're 65 years old and you're married and you and your wife or you and your spouse are in relatively good health, there's a 50% chance that one of you will see age 90. So you're really talking about a 25-year time horizon. That's not nothing. So when people are converting their assets to an income stream, there's not a guarantee like there is in a pension or Social Security. This is more important. So depending on each person, but it's definitely more front of mind for the baby boom generation as opposed to probably just their parents' generation ahead of them, which had those types of benefits in place.
So with people living longer, like specifically to age 90, if they retire at 65, almost no matter what they sell their business for, it's not going to last them the rest of their life. So what do you think they should do?
Well, it depends on lifestyle. So I have noticed. I'm just going to clump all retirees into one basket, but I think that it follows this general pattern. If you've worked your entire life, the first year that you retire, you go nuts. You take the trips that you've always wanted to take. You go see the people that you haven't seen in years or maybe even decades, so on and so forth. I mean, I keep in relatively good tact with my friends, but I still don't see them enough because they're all scattered around the United States. So when you first retire, you do all that stuff. And if you're like a handy person, you're taking care of all those honeydews around the house that have been deferred maintenance for a while. Then you fall into a pattern where you're much more active for the first 10 years. Once you get into your early to mid 70s, instead of taking 2 or 3 trips, you maybe take 1 or 2 trips a year, or maybe you travel domestically instead of a 6-week excursion to Europe. And then once you get into your 80s and beyond, then you slow way down. So, if you had grandparents that were alive in their 80s and 90s, I certainly did. There are lots of homebodies. So when you're planning, you almost have to look at your retirement in 3 different stages. One is like I'm going to get after it and go nuts and do all the things I haven't done and travel all the places I haven't ever been. But then once you get that out of your system and you get a little bit older, you spend less money. So that's why that client profile is so important. You may have enough money from the sale of your business to support your lifestyle. And if you don't, you either get to work longer, sell your business for more money, or spend less money in retirement. So that's that customer client profile that's so important that we nail that relationship, that I know exactly what my clients' goals are and how much they're going to require from how much it'll require from their portfolio.
So quick question before we get into the 5 final questions here.
Yeah.
Do you advise your clients to invest in both the public and the private markets?
Are you talking about with private markets? Are you talking about a private placement investments, like non-traded stuff? Is that what you mean?
Right. So like the stock market versus like a private business that is not listed on the stock market.
Yeah. I like stocks. I think stocks are good. I like investments that you can get out of. A lot of private investments have liquidity restrictions, and so they're not all bad. But I run into a lot of instances where clients come to me with these types of investments and they can't get out of them easily. So if you're going to look at alternative investments, illiquid investments, you really want to do your due diligence, because I know the stock market can go down, but you can get your money out of it the next day. You sell an investment, it settles the next day, and then you can pull your money into the bank account soon thereafter. Some of those illiquid private placement investments, they're good, they have their own merits, but I really caution against not being able to get your money out of those things, because I've seen a lot of problems that people have found themselves in.
All right, so we're going to go rapid fire here. I got the last 5 questions. The first
Let's
one
do
is,
it.
what does working with you look like?
Working with me, what does working with me look like? I would say that the ultimate goal for me and my clients is making sure that they are able to make confident decisions. So we have a very fun time with our clients. I like working with people who I like, and I think people want to like their advisor. Like, you go in and see this guy and they're giving you advice on your investments. You want to trust them. You want to make sure that you like. So we work on our personal relationships with clients, and we get to know them, I think, at a pretty deep level. It's all driven by the desire that our clients make confident decisions, and they have clarity of purpose. If you're going to do something, make sure it's in line with your long-term goals and you have a good reason to do so.
So if I was to take your process and give it, 3 steps, it'd be like decide, plan, execute.
Oh, yeah. And our onboarding, I can give you a specific example. The first meeting is a get to know you. We call it the discovery meeting. The second meeting, we put together an initial draft of a financial plan. In the third meeting, we review everything in the financial plan, make sure that everything is spelled out and there's a value assigned and a timeline assigned. And then we want to take a look at their portfolio to make sure that their portfolio is going to drive the returns needed for their financial plan to be successful. So get to know you, financial plan, and make sure your investments are squared away. And then we have a service model in our branch where we're regularly reviewing estate plans, tax returns for investment opportunity. We're looking at insurance for risk management. So we have an ongoing process and service model that we use with our clients.
What characteristics do your best clients exhibit?
I think my best clients are engaged. I think that we're meeting with them. We have a really good open line of communication. They're understanding what I'm telling them. I'm listening to what they're conveying to me, and the communication is very clear and open.
What's your best advice for someone looking to sell their business or transition to a new one?
Yeah, I mean, I think that when you're considering selling a business or buying a business, and I would extend this analogy to buying and selling stocks, like you have to look at the business and you have to have a really good reason to buy or sell it. You're looking at the financials, you're looking at the pipeline of business in the future, you're looking at how secure the company's relationships are with their client base or their vendors or what have you. So you're doing a full investigation. So if you and there's a bunch of examples of companies that buy other companies for no reason. So you remember when we were kids, you go into a movie theater and you'd see a golf and western, a golf and western production. Well, that was an energy oil company. You had Nabisco, RJR, the cigarette company, bought Nabisco, and it's like they held these companies for a while, then they divested them because what do crackers have to do with cigarettes? So when you're looking at buying or selling a business, you have to have a reason. So you should ideally have a vision of what you want your business to be or what you want your career to be. And if this is a strategic acquisition, how is it helping the overall business? If this is a sell this business and move up to this business, is that propelling you towards your long-term goals? So having a vision of what you want to accomplish and then having really, really solid reasons for why you would want to buy or sell businesses on your way to achieving your goals.
What's one of your favorite quotes and why?
So my favorite economist is a gentleman named Thomas Sowell. Very interesting guy, taught at Harvard, UCLA. I think he's written 48 or 49 books, prolific guy. And I just love this quote of his. I wrote it down. I'll just read it. It's very short, but I want to make sure I get it right. It takes considerable knowledge just to realize the extent of your own ignorance. And I look at people on TV puffing out their chest and saying stuff, how it is definitely this way or definitely that way. And the world is very complicated, and there's a lot of things that can trip you up down the road or along the way, rather. And I just think that you need to embrace your ignorance so that because you don't know everything and you need to investigate it. And so, check your answers, double check your answers, and make sure you're looking at the situation clearly, because there's about a trillion things every single day that are happening that we had no idea would ever happen. And there's just a lot out there. No one knows it all.
How can people get in touch with you?
People can get in touch with me. Obviously, there's the old-fashioned Google. You can just Google me. My email is bbender. I'm on LinkedIn, Benjamin Bender. But again, Carson Wealth is the RIA, Registered Investment Advisor. My name is Benjamin Bender, and those are 3 different ways you can get a hold of me.
Perfect. Well, thanks a lot for your time, Benjamin. I appreciate you coming on.